Quantum Computing Inc., ticker QUBT, delivered a mixed Q2 2026 earnings report, beating heavily on revenue but missing on the bottom line.
Right. Their revenue came in at $5.61 million, which is just a massive 9,074% increase year over year from only $61,000.
Yeah, and that easily beat the $5.15 million consensus estimate, but the EPS was negative $0.05, missing the street's estimate of negative $0.03.
And looking ahead, management expects $20 million to $25 million for the core business in 2026, plus another $7 to $16 million from their newly acquired Enhanced division.
They also have a contract backlog sitting at $42.5 million right now. But the market reacted pretty negatively to that bottom line miss and the underlying margin pressures.
Yeah, shares fell 2.51% in the regular session to $8.95, and then slipped another 1.26% after hours to roughly $8.81.
So we are going to use this deep dive to figure out why a 9,000% win wasn't enough. For you listening, the mission today is to cut through the noise of that massive top-line jump.
Exactly. We need to look at the harsh margin realities here.
We do. We are going to unpack their highly aggressive M&A strategy and really weigh the execution risks moving forward.
Because, that headline number is incredibly seductive. You see 9,000% growth, and your immediate instinct is, wow, this company has figured out product market fit.
You assume they are just scaling exponentially.
Right. And to be fair, they did see sequential growth of 50% just from Q1 to Q2 of this year alone. That revenue is being driven primarily by sales of their photonics products.
To government agencies, educational institutions, and some early commercial customers, right? So the demand is clearly there.
It is. But the mechanical reality of how they're fulfilling that demand is where the thesis gets pretty messy.
Yeah, it does.
Despite the top-line explosion, their cost of revenue actually exceeded their sales. They posted a negative gross margin of 21%.
Okay, let's unpack this. That is a brutal metric to swallow. It's almost like buying a high-end sports car but realizing you have to replace the engine every 100 miles.
Yeah, that's a good way to put it.
The top speed is incredible, but the maintenance is just killing your wallet. And their operating expenses ballooned by 114% to $21.8 million for the quarter.
Right, which was driven by R&D, scaling up their sales and marketing payroll, and this is a big one, eating $7.3 million in transaction fees for their recent acquisitions.
So you add all that up, and the operating loss widened to $23.0 million. But let me push back on the market's reaction here for a second.
Sure.
Wall Street knows deep tech requires heavy upfront fixed costs. Isn't a negative gross margin completely standard for a hardware company transitioning from lab prototyping into early commercial production?
Well, you would think so, and you are right that early-stage manufacturing is heavily burdened by fixed overhead. But Wall Street disagrees with the valuation premium here.
Because the margins are just too low.
Exactly. Yes, negative margins are standard in early R&D scaling, but at a negative 21% gross margin, investors aren't just seeing unscaled overhead.
They're terrified the unit economics are actually broken.
Right. It signals that the volume isn't there yet to absorb the manufacturing costs. What's fascinating here is what CFO Chris Roberts said on the call. He pointed out this business is highly lumpy quarter to quarter.
Oh, right, because revenue recognition in deep tech hardware isn't like a monthly SaaS subscription.
Yeah, it depends on highly specific customer delivery and acceptance milestones.
Yeah.
You might spend 6 months building a complex photonic system, right? You incur all the labor and component costs up front.
But you can't recognize a dime of revenue until the client installs it and signs off.
Exactly. And that doesn't fall neatly into 90-day SEC reporting windows. So while the 9,000% revenue growth proves they have real commercial traction, institutional investors model for predictability.
And a lumpy negative margin hardware business is incredibly difficult to assign a premium multiple to. You can stomach a $23 million operating loss if the gross margins are positive and expanding, not negative 21%.
Right, which means they have to fix the manufacturing bottleneck to fix those margins.
And building those physical manufacturing lines is exactly why their operating expenses are bleeding $23 million a quarter. Management isn't just tweaking algorithms, they are aggressively acquiring physical foundries.
Yeah, let's look at the sheer scale of this capital deployment. In the first half of 2026, QCI spent roughly $180 million in cash to acquire 3 distinct companies.
That is a lot of cash.
It is. They bought Luminar Semiconductor for $108.5 million, Enhanced Semiconductors for $73.8 million, and NuCrypt for $4.5 million.
But I have a hypothesis here that I need you to evaluate. When a company with negative 21% gross margins drops $180 million on acquisitions, it looks, well, incredibly reckless.
It definitely does on the
So
surface.
for you listening, we have to ask, are they actually buying these semiconductor foundries for true vertical integration to secure their supply chain, or are they just buying other companies' revenue streams to satisfy Wall Street?
If we connect this to the bigger picture, it explains the M&A strategy entirely. QCI is focused on photonic quantum computing. That means using particles of light, photons, to process information. Now, gate-based quantum computing is the holy grail, but it is notoriously difficult. CEO Yuping Huang actually referred to it as climbing the last half mile of the mountain. The hardest physical problem is photon-photon interaction.
Because photons don't have mass or an electric charge, they naturally just pass right through each other, like two flashlight beams crossing in the dark.
Precisely. To force them to interact and actually compute data, you have to route them through highly specialized exotic materials. The leading candidate for this is thin-film lithium niobate.
Okay, wow.
Yeah, you have to integrate lasers, single photon detectors, and control electronics all onto a single microscopic chip. You cannot just call up a standard legacy silicon foundry like TSMC and ask them to print that.
The manufacturing capability simply doesn't exist at scale.
No, it doesn't. So by spending that $180 million to acquire Luminar and Enhanced, QCI is buying the bespoke manufacturing capacity they need to build their own chips.
Oh, so the enhanced acquisition specifically allowed QCI to launch Fab 2 ahead of schedule. That gives them US-based advanced packaging tailored to their exact exotic material needs.
Exactly. It's fundamentally a supply chain defense mechanism. They are acquiring the factory, so they aren't waiting in line for a third-party manufacturer to figure out how to handle lithium niobate.
And strategically, there's a financial dual engine at play here. Enhanced already processes about 60,000 wafers a year for existing commercial customers.
Right, so they didn't just buy a lab. They bought a revenue-generating business that essentially subsidizes their own internal R&D burn while they climb that last half mile of the mountain.
That is fascinating, and we are already seeing operational milestones from this, right? CEO Huang highlighted several key deployments in the quarter.
Yeah, they successfully installed their Dirac-3 quantum optimization machine at a global consulting firm. That is a massive commercial proof of concept for portfolio optimization.
Furthermore, they announced that their NeuroWave photonic reservoir computing platform has reached full commercial readiness.
And that translates directly into pipeline revenue. They just signed a framework agreement with Planck Dynamics for an initial order of 5 NeuroWave systems,
with the potential for the program value to exceed $10 million as specific milestones are met.
Exactly. But there's a crucial technological differentiator here that ties directly back to those brutal operating expenses we discussed earlier. Huang emphasized their room temperature, chip-scale photonic architecture.
Which is huge, right? Because when you picture a legacy quantum computer, you usually picture a massive golden chandelier suspended in a laboratory.
Yeah, and that chandelier is a cryogenic cooling system. Superconducting quantum computers must be cooled to near absolute zero.
Which requires immense amounts of electricity and specialized real estate.
And constant maintenance. That is a permanent anchor on a company's OPEX and CAPEX. But QCI's photonic architecture works at room temperature. By stripping out the cryogenics, they are drastically reducing power use.
So if they can scale this chip-level technology in Fab 2, it's the mechanism that will eventually pull that negative 21% gross margin into positive territory.
Yes, but getting to that positive territory requires surviving long enough to scale Fab 2. Sustaining $23 million quarterly operating losses requires unbelievably deep pockets.
Well, here's where it gets really interesting. This brings us to the most unique financial asset on QUBT's balance sheet, their massive cash reserve.
It really is an anomaly for a company of this size. QCI ended the second quarter with an astounding $1.3 billion in cash equivalents, and investments.
Now, that is down from $1.5 billion at year-end 2025, primarily due to the $180 million they deployed for those acquisitions. But we have to put the gravity of that $1.3 billion into perspective.
We do. Because interest rates are where they are, that cash generated $13.0 million in interest income in Q2 alone.
Wait, really? Their interest income is more than double their actual operating revenue of $5.6 million.
It is. And that $13 million in passive interest income actually absorbed a massive chunk of their expenses. It narrowed their final net loss down to $11.8 million for the quarter.
Even though the operational business lost 23 million, that is wild. This gives them a current ratio of 66.67.
Which is fortress-like.
Totally. For you listening, a current ratio measures a company's ability to pay short-term obligations. A ratio of 1.5 or 2.0 is generally considered healthy. A ratio of 66.67 means that their liquid assets absolutely obliterate their near-term liabilities.
There is zero immediate bankruptcy risk here, but it sets up a fascinating valuation puzzle. QCI has roughly 225 million shares outstanding.
Okay, so if you divide that 1.3 billion cash position by the share count, you get roughly $5.76 per share in pure liquid cash.
Right. And following this earnings report, the stock was trading around $8.80 after hours. That means the cash on the balance sheet represents roughly 65% of the total share price.
Wow. So the question you have to ask yourself as an investor is, does this massive cash position create an absolute floor for the stock? Or is it a value trap if management simply burns through it all on massive capital expenditure projects?
This raises an important question because management was very transparent on the earnings call. Upgrading the enhanced facility to meet Fab 2 quantum specs will require $50 million to $100 million in CapEx.
In just the coming years, right?
Yeah, they expect the bulk of that to hit later rather than in 2026, but that bill is absolutely coming due. And this looming CapEx requirement is exactly why Wall Street analysts are completely divided.
Right. You have Northland Securities maintaining an outperform rating with a $20 price target. They're essentially betting the vertical integration yields a massive first-mover advantage.
But then you have Cantor Fitzgerald maintaining a neutral rating with a $10 target. And Cantor's model is deeply revealing when it comes to understanding how institutional money views deep tech.
Let's break down Cantor's math for the listeners because it highlights the extreme long-tail nature of this investment. Cantor projects that QCI can capture 5% of the total global quantum market by the year 2035.
Right. They estimate that 5% share equates to $375 million in sales a decade from now.
And in finance, a dollar 10 years from now is worth less than a dollar today. So Cantor takes those projected 2035 sales and discounts them back to the present value using a 10% discount rate.
Exactly. That math gives them a present value of $159 million for the actual operating business. They add back the cash cushion, and that's how they arrive at their $10 valuation.
It illustrates perfectly what you are buying today. You are buying a massive immediate cash cushion attached to a highly speculative, highly distant cash flow stream.
Which brings us to the volatility. You have to size this position appropriately because the stock has a beta of 3.79.
For context, the broader market has a beta of 1. So a beta of 3.79 means this stock is nearly 4 times as volatile as the S&P 500.
Yeah, and we've seen it trade at a 52-week high of $25.84 and a low of $6.18. Now, the cash absolutely limits the immediate downside risk.
It ensures basic survival. Management even noted that their $42.5 million contract backlog alone could sustain operations through the third quarter of 2027.
Even if they didn't sign a single new contract tomorrow? But the execution risk threading that cash pile is paramount.
It really cannot be overstated. We talked about how brilliant the M&A looks on paper for securing the supply chain, but in reality, integrating 3 distinct, highly technical hardware companies is a nightmare.
Right. Merging Luminar, Enhanced, and NuCrypt into a single, cohesive operating unit is one of the hardest things a management team can attempt. M&A looks great on a spreadsheet, but
You're dealing with aligning different engineering cultures, right?
Right.
And standardizing enterprise software.
Exactly. And trying to scale a unified commercial sales team all at the same time. This is where deep tech roll-ups historically stumble. If they mismanage the integration, Fab 2 faces delays.
And if Fab 2 faces delays, that $100 million CapEx bill could easily inflate, and that negative 21% gross margin will persist much longer.
The cash is a phenomenal defense, but it is not infinite.
And as an investor, you always want to look for alignment between management's actions and their public confidence. There is a specific risk factor from the SEC filings regarding insider activity.
Oh, the CFO's stock sales?
Yeah. CFO Chris Roberts sold over 78,000 shares in the last 6 months across 2 transactions. And there were no reported insider purchases by the executive team to offset those sales.
Which is a data point you have to weigh objectively. I mean, executives sell stock for all sorts of personal reasons: taxes, buying a house, portfolio diversification.
It does not automatically mean the underlying business is failing.
No, it doesn't. However, context matters. When management is asking the public markets to trust their execution on integrating 3 complex companies, and stomach a $23 million operating loss.
Heavy insider selling just doesn't send the most confident signal to retail shareholders.
It adds friction to the narrative, for sure, and contributes to the caution we saw in the market's negative reaction to the earnings print.
The market is weighing the reality of a massive corporate transition. The 9,000% revenue growth is spectacular, and delivering a DRAC 3 system to a global consulting firm proves this technology is not just lab vaporware.
The room temperature photonics approach is undeniably attractive because it structurally circumvents the massive cryogenic expenses that plague legacy competitors.
But QCI is morphing from an IP-heavy research outfit into an asset-heavy semiconductor manufacturer that requires time, flawless execution, and a lot of cash burn.
It is the textbook definition of a deep tech risk and reward scenario. The downside is structurally insulated by that $1.3 billion cash floor.
But accessing the upside requires management to execute perfectly on a remarkably difficult manufacturing roadmap over the next 3 to 5 years.
So synthesizing all of this for you as an investor analyzing QUBT today, this is a highly speculative high beta play.
You are looking at phenomenal top-line growth and a fortress balance sheet where cash essentially anchors 65% of the stock price.
But you must aggressively weigh those strengths against the brutal realities of hardware manufacturing, negative gross margins, massive looming capital expenditures to upgrade Fab 2, and incredibly high execution risk.
The cash buys them time, but it doesn't guarantee they can climb that last half mile of the mountain, which leaves you with a final strategic question to mull over as you model this space.
Right.
If QCI's room temperature photonics architecture is truly as revolutionary and cost-effective as management claims, and they now own the physical U.S.-based manufacturing capacity through Fab 2, what happens if a legacy tech giant simply decides to acquire them?
Oh, that's an interesting thought.
Rather than letting QCI scale independently and risk execution failure, a mega-cap company needing to secure its own quantum supply chain could easily digest a $2 billion market cap to acquire both the IP and that bespoke foundry capability.
It is a dynamic situation that will evolve rapidly as Fab 2 comes online.
Keep an eye on how these acquisitions integrate over the next quarter. And make sure to follow the show for our daily earnings coverage so you never miss a deep dive into the numbers driving your portfolio.